Hi, I'm Dan Cooperstein, and welcome to Compliance Minute. On July 8, 2016, the IRS published proposed regulations that will have an impact on employer penalties under the ACA. These regulations include new rules on ACA premium tax credits, opt-out arrangements, and pediatric dental plans, among other topics. But for purposes of this episode, I think it's important that we focus on the new rules about opt-out arrangements, since these are quite common, particularly in schools and unionized workplaces, and getting this wrong can increase the amount of the penalty that your organization may be facing under the ACA's pay-or-play rules. To provide some background, under the ACA's employer shared responsibility provisions, which are commonly referred to as the ACA's pay-or-play rules, the IRS will impose a tax penalty on applicable large employers that do not offer their full-time employees affordable minimum value health insurance coverage if any of those employees also qualify for and obtain a premium tax credit to purchase coverage through an exchange. With respect to the affordability component of that requirement, such employers can avoid a pay-or-play penalty if their coverage satisfies one of three affordability safe harbors. Although the method for determining affordability for each safe harbor differs somewhat, each of the safe harbors has one thing in common. Each method is based on the employee's required contribution for the employer's health coverage. So what are opt-out arrangements and how can they impact ACA affordability? Opt-out arrangements occur where employers offer employees a cash-out payment to waive or decline the employer's offer of health insurance coverage. This cash-out payment is referred to in the rules as the opt-out payment. In IRS guidance from December of 2015, IRS Notice 2015-87, the IRS explains how opt-out payments may affect the amount of an employee's required contribution for purposes of determining affordability under the ACA. Specifically, the notice explains that there are two types of opt-out arrangements: conditional and unconditional. Generally, conditional opt-out arrangements require employees to have a reason for why they're declining the employer's coverage. So the employer, and as part of these, the employer has to generally verify in some way that the condition has been satisfied. So, for example, an arrangement requiring an employee to submit to the employer proof that he's eligible for coverage under his spouse's plan. By contrast, unconditional opt-out arrangements do not have any such conditions. In these types, for example, the employer just gives the employee cash upon the employee agreeing to decline coverage. The notice explains that the amount of the unconditional opt-out payment, the payment that's given out without any reason, will be added to the employee's cost of the coverage for purposes of determining ACA affordability. By contrast, the opt-out payment in the conditional opt-out arrangement scenario is not added to the cost of coverage for ACA affordability purposes. The new proposed rules clarify these rules even further. The proposed rules, which are intended to be effective for plan years beginning on or after January 1st of 2017, provide that unless an opt-out arrangement qualifies as an eligible opt-out arrangement, then the amount of the opt-out payment will be added to the cost of the employee's coverage for ACA affordability purposes. Under the proposed rules, to qualify as an eligible opt-out arrangement, opt-out payments can only be made available to employees who, 1, decline employer-sponsored coverage, and 2, provide reasonable evidence that they and their expected tax dependents have or will have minimum essential coverage other than individual market coverage during the plan year or other period covered by the opt-out arrangement. So what do employers have to do to comply? Well, under the proposed rules, employers will need to establish a verification process to ensure that the arrangement will qualify as an eligible opt-out arrangement. The rules specify that employers will be permitted to use an employee attestation for this purpose. Further, evidence of coverage must be provided for each plan year to which the eligible opt-out arrangement applies. Fortunately, under the new rules, there is some transition relief available. This transition relief provides that employers are not required to increase an employee's required contribution by the opt-out payments that are made available under unconditional opt-out arrangements that were adopted before December 16th of 2015. For more information on this and other topics, please visit our Knowledge Center at corpsyn.com. Thank you.